Got it.
Perfect. Hey, what is going on,
All right,
guys?
man.
My name is Ben Trades, and in today's video, I'm going to be joined by Terra Trades, aka Kane Trades. His Discord is actually going to be in the link of the bio of this video. Kane, tell us more about your Discord, because I'm actually very curious.
What's going on, guys? It's Kane Trades, and first and foremost, I want to thank Ben Trades again for letting me be on this
Bro,
interview. It
I
was one of
thank
my
you.
biggest
I
regrets.
thank you, bro. I thank
This is
you.
one of my regrets of not being able to thank him in the actual video did in the comment section. But again, want to show my respect. I appreciate you giving me the time and space to talk on here. And like Ben said, this video is sponsored by my trading server and community, Terra Trading. We're one of the only free trading servers out there that specializes in ICT concepts. So if you really want to come in and learn, we have ICT daily notes and recordings on market review, homework every single week. So if you want to get in that extra practice and go the extra mile, we have lives every single day. We don't want to charge for concepts that aren't our own. So come in and join and chase after financial freedom with us.
Beautiful, brother. Dude, I just want to thank you for something. Believe it or not, one of your concepts that I've never heard before, by the way, for the last 5-6 years, I've never heard about this concept. And you're the one that brought it up after me being in probably tens and tens of thousands of dollars trying to push my way to profitability. And, you know, like watching all these YouTube videos like ICT and Aljo and TJR, you know, really trying to come up, right? And one of the concepts you actually mentioned, or I was on your Discord this one morning, and dude, I swear to God, that concept right there has brought such a tool into my life. I've made so much freaking money. This is why we're doing this. This is why, because I'm like, dude, this guy's psychology is up here, but the fact that his technicals are so precise that I can't neglect it. I have to have him on so you could show the people how it's done. Because, dude, now you're saving people money on the defensive side. Now you can show people how to make money. Obviously, not financial advice. Never.
Yeah, let's
Right.
just put that out there.
But-
Not a financial advice.
There
Go
you
talk
go.
to your professional financial advisor.
But the concept of the first presented FEG is goated, bro. It's amazing, bro. Dude, I was shocked. It could be used as a support and resistance IFEG, and obviously your typical FEGs, and especially if it's aligned up with the the SMTs or higher time frame order blocks and fair value gaps, they're very probable. So I just want to thank you for actually showing me that. I didn't know it was that significantly important.
Yeah, of course. And first and foremost, we got to give credit to ICT. I learned that from him, so it'd feel wrong for me taking direct credit for any
Yes.
of that stuff. But of course, that's just one of the many tools that I use and show off every single day in our lives. And it's mind-blowing, right? And the first present fair value gap, even today, this is really going to blow your mind. You can not only use them as fair value gaps, but you can use them as inverse fair value gaps, as you mentioned.
Yeah.
But the crazy thing is, they are still reference points for price
Yes.
several days later.
Dude.
And today, price action referred to yesterday's first presented fair value gap had a massive reversal.
Yes, dude. I was about to say, I forgot to mention that part. Yo, the amount of times I see it come back into the first FEG of the day is diabolical. Like, every single time you see it tap at like 6-8 rounds throughout the PM session, morning session, London session, just every session, it just comes back, and it could be such a amazing pivot point to look for trades. You know what I mean? Kane, do you mind taking off the dashboard towards the right and really zoom into the chart? Like, yeah, the pairs. There you go.
Sure.
Yeah, perfect. Yeah, now it's way better. All right, so
Gotcha, man.
Kane, man. So we're gonna talk about technical analysis. So let's talk about market structure and liquidity.
Yeah, of course. Market structure and liquidity. What is there not to say about liquidity? Liquidity is the lifeblood of every market. It is forex, futures, options, stocks, everything, even crypto, right? Which we don't want to go there. But, if you do crypto, no hate against you. But mad respect to you guys. You guys go crazy. But anyway, liquidity, though, it's everywhere. And you can find it. And it's what drives the market every single day of every single hour, every single trade, right? I think it's one of the most vital skills to get locked down on, especially if you're a new trader, and even if you're a more experienced trader. It's no shame in sharpening up that tool of understanding market liquidity pools, and understanding where the market's trying to engineer liquidity, and of course take out opposing liquidity. So we can really dive into that and go into today's technical analysis, or we can dive into really what is the important liquidity to look out for and how it can be targeted to become a profitable day trader. Because at the end of the day, liquidity is all you really need. Of course, we have all these other important technical analysis and aspects to get us towards that liquidity and find proper entries. But liquidity is what's going to drive the market at the end of the day.
Kane, I just want to also point out to the people that are watching, make sure to grab yourself a page and a pen so you can take notes, because binge watching will not lead you to any sort of success.
Absolutely, right? And I have to do this. I have to put a little flex out there, but I challenge you guys to, keep up with my notes, man. I got 3 full books, and I'm working on my 4th one now, full to the brim of ICT notes. And even when I was first starting out, all my trades, it's vitally important to not only journal your trades and reflections to get good data and see how you feel to improve yourself, but also, take notes on today's stream, because you're going to learn a lot, right? If you don't know this stuff, you're going to learn a lot. And even if you do, it's always good to sharpen yourself back up.
Not even just that, but back testing and, like looking back at your notes too. And dude, it's funny you say that, because I'm actually on my 4th book as well. I stopped studying really about a year ago when I found more success. Like I don't really like to change my concepts that much, but it's always good to look back at them. So you're completely right,
Yeah,
Kane.
of course.
100%. So could you mark out some parts of liquidity so we can identify them for the people that have absolutely no idea?
Sure. So we can start off with the bare basics of liquidity, and we can really work our way real quickly. So again, if you guys need to rewind this video, feel free to, right? Put it into put in the hours and put in the work, right? If we're going too fast, don't be afraid to go back and really lock down and be like, what are they talking about? Let's make sure we understand this. So first and foremost, let's start with the real bare basics and keep it real quick here, because I'm sure a lot of you guys watching already know this, but where's liquidity found? It's basically found at opposing highs and lows. And the reason why that is because traders, from a logical standpoint, know that, hey, if I'm shorting, let's say at this high over here, right? A high is an up candle followed by a down candle. If I'm shorting at this high here, I would want to put my stops above, well, maybe this high over here, or even above this, because you do not believe as a trader that price action is going to go up. You think it's going to go to short. Why would you have your stop loss above this area where you shorted? Because if you think it was actually going to short, and vice versa, let's say, and again, I'm going to remove this breaker here for simplicity. Say you're going long here at this low, you'd likely place your stops either below a previous low or the low right there, because again, you don't believe price action is going to go any lower, and you think price is going to continue long. So you're going to find liquidity at highs and lows, especially previous significant highs or lows, because that's where traders are taught to put their stop losses, because they want to protect their orders, right? That is as simple as it gets when it comes to liquidity. So what is liquidity going to do? Target out previous highs and lows, right? And the best ones that you can find are relative equal highs and lows. That's where you're really going to find major pools of liquidity, especially where the market's smooth. You see how the market makes a very smooth relative equal highs here, then immediately goes and targets that out. Very, very awesome, right, to see. And even in other instances, right, with earlier in market structure, where we see, again, today, this was earlier in pre-market, New York takes it out, right? And we can see relative equal highs and lows. Even here, we have somewhat sort of similar. Wow, crazy alliteration there, but equal lows right there. And of course, price action wants to target and at least take out some of that. That's what price action will always want to do. Take out equal lows, and you see price action annihilates it right there, taking out all the traders going long. That's a very simple breakdown. You know where the equal highs are, you know where liquidity is now, you know how to find it, and you know where price wants to target, especially where those important pools are against relative equal highs and relative equal lows.
So when ICT explains that, the liquidity is taken and you want to look for the opposite of the trade, right, align with your bias, how would you identify the market structure shift?
Yeah, so getting into market structure shift, that's a very pivotal confirmation. Of course, not a lot of times, and very rarely, unless you are the best of the best traders and you were just him, and you know, okay, well, this sweep, I'm going to immediately long off of this. Not many traders can do that, and very, very few traders can do it consistently. So, of course, you're going to need some confirmation, like a market structure shift. And how can we observe a market structure shift? Well, a market structure shift, also kind of known as a change of character, they all have slight variations, is where we take out for example, a previous swing high right here. And let's say we were looking for longs and we just observed price actually take out these lows right here, here, and here, these key lows over here with this sweep. And we're waiting for a market structure shift to target something higher here, right? We would find the market structure shift right over here by closing above, right, price action of this previous swing high, right? So we have this swing high here, we close above it, that would be a market structure shift, and we go up and continue to target. Now in this example, it's not much more, but that would be good confirmation to continue up. And if your strategy is, I want to see a liquidity sweep market structure shift, right? That's all you need. That's literally all you need. And you can see price action even references this order block right here with this candle down, target up this inverse fair value gap right here. Flip side, we see the bearish example, right? You want to look for some swing lows. Again, this would be the most important swing low, but you have a couple here on the 15-minute. So I'm sure if we hop down on like the 5-minute right here, you can see very key swing low right here and one here as well. We see price action close below that, and boom, price action after coming up, sweeping out the relative equal highs and even giving a bit of a turtle soup here, accumulation. We then reverse after that, market structure shift. You can find an entry here on a lower time frame in a fair value gap, or you can see how price action references this order block right here and absolutely collapses down to target out these relative equal lows over here. So it's all about understanding where the liquidity lies, and of course, waiting for good confirmation like a market structure shift by closing above and below previous swing highs and swing lows respectively.
So you use sell side and buy side liquidity at highs and lows. Do you use them for your trading setups?
Yeah, absolutely. Now, liquidity can be found anywhere, but the majority of liquidity, of course, is going to be found in those pools above key swing highs and swing lows, like these relative equal highs and relative equal lows. And of course, that's what we want to do. I want to trade what the lifeblood of the market is. If that's what's moving the market and moving the algorithm, I want to be a part of that move, right? And I want to be a part of the system that's going to move price. And of course, that's pretty much how I find my trades. Getting a bit more into my strategy, right? I wait for price action to tag some liquidity opposed to my bias, and then I wait for price action to give that confirmation like a market structure shift or a change of character. And then after that, I look for my entry model, which is just a unicorn model that is a fair value gap breaker, one of the strongest ICT models out there. And that just gives huge confirmation that price action has not only referenced that liquidity that we've taken, but then also given yourself a beautiful entry model to target out opposing liquidity. And of course, if you run into other confluences, like we talked earlier about the first percent fair value gap, that might be a great place to take a partial or even have your terminus.
So speaking about like mitigation blocks, breaker blocks, and FEGs, what do you prefer usually?
Ooh,
Is
that's
it
a good
really
one.
just
So
whatever you see, or is it something really like? For me personally, I love order blocks. Like I've been more attached to order blocks than FEGs itself because for me, I have 6 criterias to identify an order block. So I don't pick the FEG and a discount. For me, it's a little bit more specific, and it helps me. I want to ask you, what's your preference?
yes, it's like playing chess. Is it the knight or the bishop is your favorite, right? They're equal value in the eyes of the market, but again, it's all situational in my eyes, right? When I first started out, I really gravitated to the fair value gap. They're so
Everybody
easy to
did.
spot. They're so easy. Yeah, it's like everyone's like, wow, I love this bishop that can just run halfway across the board, right? It's super easy to use. But the order block, right, just like the knight, is very tricky and can be very underrated and very powerful. And it's one of those situations where you just have to understand what the market's trying to do. Sometimes it's not going to provide a great fair value gap. Sometimes it might be a bit slower or on the time frame that you may be looking at, right? Now, I'm very I don't want to say super strict, but I'm pretty much locked in with my model. I don't want to chase around price and be like, oh, well, it's this liquidity sweep, and then there's this well, order block is kind of here, right? I don't want to make up reasons. You always want price action to come to you. And so I stick with my model of fair value gaps and breakers. But again, it's all situational. There's tons of times where during the live in the Terra Trading server, I will mention like, hey, this is a great buying opportunity off this order block. And price action has referenced it, and it's probably going to continue up, right? Maybe not something I specifically trade, but something that I'm definitely going to be aware of and absolutely use in order to, well, understand price further.
How do you how does FEGs influence your trading decisions? Because for me personally, I see that, let's just say I have a higher time frame for a value gap that's against my bias, or it's just getting in the way. Like I call it the ping pong effect. You have like a support and a resistance, and it's playing the ping pong between both. How do you not let that that thing influence your decisions by having something like this criteria and this other criteria, and now maybe it's lower probability? How do you stay locked in to a narrative and a bias?
Yeah, of course, right? So there's always going to be counter confluences, and that's something you have to be aware of. And that can be such a snare sometimes in your trading, especially when you're in profit, you're chilling, you're cruising, and you hit that confluence, right? This is how you have to attack that. You have to take a partial there. If it's going to cause you concern, right? And it's going to cause you fear in the market that it's going to reverse and it's going to get in your head, right? If you have a very clear bias. Now, there's two ways of approaching it. And the first one, I'm going to continue with what I was just saying. If you're afraid of that confluence, or you're concerned, right? Maybe not afraid. No one's screaming at their PC. Well, maybe some traders, but if you're if you're really afraid of a confluence, let's take this first percentage fair value gap from today, right? You could be in a short here. You see the liquidity sweep, you see the market structure shift, you see the order block, and you're like, dang. Kane talked about first percent fair value gaps. They are very strong. Ben also talked about first percent fair value gaps. They're insanely strong. I don't want to get completely reversed here. That's cool, right? Take a partial there. Set your stops at break even. Then that's all you need to do, right? Or, cover costs and commissions. That's all you need to do after that. Because then whatever price doesn't matter if price goes up 1,000,000 points off of it. You're still going to get tagged out, not only with a partial profit, but also you're going to get tagged out, and you're not going to lose any money on anything. That's one way to approach it. Another way to approach it is stay back, right? If it's a very, very powerful confluence with clear bias that goes against you, and it's a 50-50 coin toss, stay out, right? There are tons of opportunities within the market. Let the market develop, and even if you don't find anything, and I didn't find anything today. I didn't see anything I liked. Market was moving a bit too slow for me today on this No News Wednesday. And that's okay, right? Because I'm going to reiterate something very important in but our previous stream. The next day is only 24 hours.
Yo, you read my mind. Yeah. Oh, Kane, by the way, I was about to mention this. Sorry for cutting you off. You're fine, man. I'm actually having a poster. You get hyped. I'm actually having a poster of that quote on the wall right behind my stream, and it's coming in tomorrow. 24 hours
is sick.
Yes, because we keep talking about it on stream. My buddy, my partner, Adrian, or Fresh, as you guys know, is always talks about the quote. Today we had 2 break-even trades, and he said, you know what, Vince, let's just get off today, because the quote that Kane said, the next day is only 24 hours away. And it's actually less than 24 hours away. You know what I mean?
Exactly,
so I'm actually
right?
having the quote. I'm having the quote pulled up here, right there. You'll probably awesome, see it by Friday. It's gonna be right here. I'm gonna send you a picture. You're gonna love it.
I'll join the live stream.
Yeah, you're gonna love it. I'm gonna frame it right there.
That's awesome. Hey, that I get to be a part of Ben's trading space, immortalized. But absolutely, right? You guys have to remember that the market's not going to implode. The world's not going to end, right? It's going to be there tomorrow, and it's going to be there the next day. It's going to be there the next day, and so on and so forth. There are going to be plenty of opportunities. And heck, there's probably going to be more opportunities within that session to make a bunch of bread. And again, that shouldn't be your focus, but there's going to be more opportunities to take great trades. And so if it's not there, and you're in that situation where you see a very, very powerful confluence that is opposing you, and some counter bias and counter narrative that you can't shake, that you say, wow, I do respect that, right? Be aware of it. And if it's too much, hands off. Just call it a day. Nothing wrong
Love
with
it.
that.
Managing
Because
risk.
one last thing I'll say on that. You'll beat 90% of the traders, even if you do nothing. If you do nothing, you're beating 90% of the traders out there because this market's built to beat you. But the majority of traders are not going to realize that. They're going to overtrade. They're going to overleverage. They're going to blow their account, pay another reset fee. And sometimes just by doing nothing, it's the right move.
Kane, speaking about 99% of the traders, what is the biggest manipulation trick that retail traders fall for?
Ooh, yeah. So there are a ton of them that instantly pop to my mind, but one of the most fascinating ones that I always see. So of course, just gonna reiterate, I'm a Top Step ambassador. I work along in the Discord in the Top Step server. Very blessed to be a part of that team. And of course, I have to work in the indices channel. I see, of course, literally at 6 p.m. EST, everyone's fiending for a trade right away. But in some of those chats, I see so many times traders mistaking, as we talked about earlier, relative equal highs and relative equal lows as clear support and resistance, especially when there is a massive confluence right behind it, or right above it in this case, or right below it in this case, right? So as you can see here, we have price action in these relative equal lows that have formed resistance, I guess you would say, or support in this case, off of this new daily opening gap, right? And so relative equal lows. So traders for a huge margin are going to be buying up here, buying up here, buying up here, buying up here. And while they may breathe a sigh of relief as they pretty much get saved here and this move goes up, they're going to find eventually they're not going to be able to catch those longer term trades because price action always loves to come back and absolutely annihilate those relative equal lows and relative equal highs, and especially come down to higher time frame liquidity like this previous daily low here, the February 3rd low, and so on and so forth, and currently in this huge fair value gap right over here. And those are key targets. So that's a huge trap. Just a lot of traders think it's support resistance on these relative smooth highs and lows. And it's a huge trap because 9 times out of 10, I'll watch them mention that and then I'll watch them say done for the day.
Exactly. You know, I look back at like traders like Dakota. He trades support and resistance, but he's not your typical retail trader. He doesn't look for highs and lows. He'll trade in the middle. He'll have a stop loss to highs and lows, yes, of course, but he's going to be looking for a different narrative and bias than most retail traders that go on the Amazon books and so on, you know. But for you, obviously, what role does the daily bias have on your
Yeah, of course. And first and foremost, no shots at any support and resistance traders, right? You guys trade what you want to trade, and Dakota is an incredible trader. I've watched him
Amazing.
trade. It's insane what he does. I think he took like about a $300,000 payout recently.
More.
I saw that
Recently,
in the Top Step
yeah,
Discord.
exactly, yeah.
Yeah, so I saw that. It was wild. So huge congrats to him. But of course, right? Yeah, he definitely doesn't trade like most retail traders. Of course, I walk in to the indices channel, I'll see people trading, all these patterns and candle patterns, not really understanding how the market's going to be targeting key liquidity and of course key concepts and how the algorithm is going to move. But again, it's very surgical and that's something you're going to have to study, and it comes with time because technically any trading strategy is going to work. But at the end of the day, right, in my mind, some are going to work a lot more than others. And it's all about how you manage your risk. But getting into the question you ask on daily bias, right? How do I find my daily bias? How does that affect my mind? Well, it's very simple. It's a very key ICT concept found in the 2024 mentorship that really just does a very quick, easy, like 5-second bias, right? And then the second thing, of course, and I'll get into that key concept in just a second. The second thing is, of course, observing what has happened in the market recently, understanding what key inefficiencies need to be rebalanced, how far, like for example, in today's NASDAQ and the previous few days, we've gone down massively over like 15, or not 15, but like more like 1,000 points down in the past few days. So I really do think in times like this, it's very important to see price action have some sort of rebalance, take out some of the trailing buy stops. And that's what I'll be looking for opportunities. Now, in today's example, we do see that happen, come into a key efficiency, and then make the next leg down. But for my daily buys, I really just like the opening range gap. Now, for those of you who are unaware with the opening range gap, it is a concept in the 2024 mentorship where you take the overall and overarching previous settlement price. So take notes if you need to. So as we see, price closes right here at 16.55. So again, we're on the 5 minute, so it does close at 16.59. And again, price action opens up right here at 9:30, right over here.
About, yeah.
Yep. So okay, so it's going to open here. So in this case, it's not a huge previous settlement price, but you want to see price action. In this case, this is not something I would really take into account for today because, well, again, it's very, very small. But normally when we have bigger ranges, it can be very good to see price action trade down to the equilibrium level in this case, which again, it does within the first few minutes and fills out the entire opening range gap, completely reverses after doing that. It's filled the objective. So of course, what I want to see when I came into a day like this is, hey, I would like to see the opening range gap get filled. It does do that, at least to the consequent encroachment. And then I want to see some relative equal highs get taken out because, again, I take both of them into account. We've been going short for a long, long time. And so I mainly took the idea that I wanted to see price action fill out those relative equal highs. More important because, again, the opening range gap was so small. It was only about 30 points, 30 handles-ish. So again, when it's much bigger, let's say, for example, the opening range gap looks something like this, right? I'd be definitely looking for price action. Now, again, this is completely wrong, but for the marking, but this is just example. I would like to see price action trade up to the consequent encroachment. Hey, that's above relative equal highs, comes into an inefficiency, and then it can fulfill whatever it wants to for the day. That's my objective, right? So, and I try to find trades that fulfill that or bounce off of that, right? If I miss that opportunity, there's definitely opportunities to trade price action reversing off those key inefficiencies and after its objective is done.
Gotta love it. And we're always speaking about time-based trading. You were mentioning 9:30, and we talk a lot about 9:30, like the first FEG you see at 9:30, the first opening gap you see, the new daily opening high, and all of these things that usually happen between a time frame. Why is ICT really related on time and price?
Yeah, of course. ICT discusses the algorithm, right? Algorithm is going to insert itself, especially during these key times. And the way to trade is time and price, right? Obviously, for a quick example, you're not going to find a lot of volatility at midnight, right? Because not a lot of people are going to be trading that, and the algorithm isn't really going to be active. But of course, we see an injection of volatility at New York Open at 9:30. You can see the candles become much more aggressive and much more volatile. And then once it starts selling itself out from the opening injection of volatility, the algorithm starts targeting what it needs to target. And again, the key time frames are the macro times. The macros are going to open a whole new world of trading for you if you are still new to trading. So we're going to hop here on the 1 minute real quick, and we can see right at 9:50. So the last hour of price, or the last 10 minutes of every hour to the next 10 minutes of the new hour, is the macro. So it's a 20-minute window where we see price action target two key things, right? Liquidity or inefficiencies, and price action does both of it right here. As we can see, right around 9:50, we see price action rebalance this order block, accumulate for a little bit, and then right at 10:10, we start seeing the run, right? We see the run right at the end of the macro time, taking out relative equal highs, doing exactly what it needs to do, right? So of course, it's not going to be 9:50, it's just going to shoot or go down, right? That's not how that's going to work, but we should expect price action to trade to an inefficiency or liquidity during that time frame, and price action does that just beautifully. And we can take a look at the 1050 macro right here. Boom, accumulation. After we do that, we tap out of yesterday's first presented. We chop, 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 chop. Hey, look what's coming around, the 1050 macro. Guess what happens? We take out more buy side liquidity and we tag out into that inverse right at around 1110. If that doesn't blow your mind, it should. It really should. And it's just crazy of how price action is going to really book it during those key times and really take out key inefficiencies. So if you can take in time, price, great models, and risk management, you're set, right? Of course, studying and rehearsing and taking good data and improving, you're going to be on your way.
Speaking about risk management, when you're entering a position, how do you cover the risk? Do you trail on specific key levels, or do you trail your stop loss when buy side or minor buy side is taken, or do you take partials, and that obviously makes your stop loss less significant than at the early entries? Or just give us a basic idea of how you manage a certain position.
Yeah, of course, right? That's a great question. And that's a question I get a lot in the Terra trading community, right? How do I manage a trade? How do I, you know, get rid of that fear, and especially the psychology aspect of it? I get a lot of questions on that, but we'll keep it nice and brief. How do I manage a trade, right? I think it's very important, as we were mentioning earlier, to take partials at key
Mm-hmm.
counter confluences or key liquidities, because you never know when price action exactly wants to reverse, right?
Mm-hmm.
And again, I can't say that anyone for a exact certainty to the tick every single time knows when price action is going to reverse. No one knows that,
But
right?
I'm that
And
guy.
so, okay, right.
No,
So, so maybe I need to reverse the interview. I'm gonna interview
dude,
you.
the worst time I had to cough, bro. That's how you know I'm capped.
Oh,
I like choked
the
on my own
world's giving you a
saliva.
little.
I choked on my own saliva
The
as soon as I
world's
said,
giving
I'm
you
that
some.
guy.
World's
Oh
giving
my
you some
god.
pharma, man. You're choking. You're choking. Anyway, back to what we were referring to of price action, right? And how I manage a trade. Whenever I'm in a position, right? So we'll just, for example, take a look at a trade that I hit yesterday, right? So it was this 5 minute unicorn, which was 5 minute. So we'll even hop on the 5 minute real quick, just to make sure this is nice and pretty, right? So we observe price action shorting throughout the day. Price action comes into this set of liquidity down here. Now, it doesn't look like it comes into liquidity, but on ES it does. Of the February 3rd, it takes on ES, doesn't on NQ, massive SMT. Wait for price action and give that market structure shift, which it does here, but I wait for here. We get the 5 minute fair value gap and the 5 minute breaker block. That's a unicorn model. How do we manage this trade, right? Very, very simple. Now, there's two places that you would want to take your profits, right? You want to take it in above the previous high. Boom, instant partial, set your stops to break even. And then I was targeting these trailed buy stops here. That's my terminus, right? I'm either going to have 1 to 2 partials max, because after that, if you get to too many partials, it's going to really eat down on your RR, and that's not something I recommend. Again,
Especially
I know
long
some
term.
traders who are crazy, especially if you're taking long trades, who are crazy at taking really, really good partials, and it works for them, right? For me, I want to stick to 1 to 2 partials. Most of the time, I stick to 1 partial, if that max, right? And then I have my terminus, right? I have my objective. I have the previous swing high or swing low, depending on what direction I'm going. Cool. Take my partial, take my trailed buy stops, or in this case, my terminus. And after my first take profit, I'm going to, or my terminus, right? If it gets to a point where I could take a partial, I'm instantly setting myself to break even. And then after that, I'm managing the trade based on what I see in the market. For example, in this case, where we see price action reference this order block right here, I move my stops from break even, and price action moves up to here. I move it to the consequent encroachment of this fair value gap, because we decided not to come into here, and we decided to tag this order block. I put it at the consequent encroachment level. It can hang if it wants to come down into the upper quadrant of this before going to terminus. That's cool, right? But that's how I manage it, right? It's all based on two things, right? Partials, right? Especially at previous swing highs and swing lows before my terminus if I need to, or if it just hits my terminus, I don't need to. And second, of course, right, once I manage the trade based off what's happening in that specific scenario and how I can find good places and logical places to guarantee profits. That's what you want to do at the end of the day. You want to guarantee income from the markets. That's the whole reason you're trading. So set partials or take partials when you need to, secure the money, right? And of course, you also want to set logical stop losses.
Do you ever use the midnight opening price as a Judo swing? And if you do, or you don't, is there any Judo swings that you usually like to use, like a fake out move before price goes higher? Like, for an example, my favorite one is you have the first FEG around 9:30, right? Around, sometimes it's a little bit before, like 9:28. It's not the first FEG, but it's an FEG where you're trying to look a buy. And then the price whipsaws it. It grabs the low of the FEG, respects the FEG, and then goes higher. I call it the 9:30 equities buy or sell. Obviously, it could be vice versa. And it's pretty much the swing low from like 932, 933, taking out the sell side, but respecting the first FEG that it created beforehand. And it's amazing. It's an amazing buy model. It takes out the sellers and pushes price higher. That's my Judah swing that I use. Is there any Judah swings that perhaps you use, like midnight opening price? I know it's a Judah swing, or 8:30 is another Judah swing, or it could be anything that I've never heard of.
Yeah, of course. That's always a good question. Now, I don't really use 8:30 and midnight as much as I used to. I definitely did, right? Back in the day, I'd have them marked out and have them as good reference points for price on top of the new daily opening gap. But between the confluences that I really like using, like the opening range gap, the new daily opening and new weekly opening gaps, I feel like adding the 8:30 and the midnight got a little bit crowded on my charts. I was over analyzing a lot of things and taking too many partials. That's why, right, I haven't been marking them out recently. I've pretty much just been sticking to what's been working for me, which is just marking out those new daily opening gaps and new weekly opening gaps, sticking to my model of just the unicorn model once I see price action. But a good Judah swing, like we were talking about, right, you could possibly see those off those key
Like minor
highs and
liquidity as
smooth
well.
lows.
Sometimes it could be some sort of like Judah swing.
Exactly.
Yeah.
Exactly. You can see that especially off the relative equal highs and relative equal lows, where price action really likes to take out some liquidity and then completely reverse. So that is a good example there of a Judah swing that we could potentially use by taking out relative equal highs, relative equal lows. Am I
Love it.
personally like specifically saying, hey guys, this is a Judah swing off the 8:30 midnight? Not as much as I used to, but it's still something that I have practiced in the past.
Have you ever hesitated on a perfect setup? And if so, how do you avoid hesitating?
Yeah, man, people in the Discord have clowned on me so much that we've made even custom emojis laughing at me whenever I make like a hesitation or something like that, and that's totally part of trading, right?
Human. It's not even trading.
It
it's
is.
Human.
It is, right? Of course, money is monetary. We don't want to lose our hard-earned money, and especially if we're on a live account, that's not something we want to risk losing. And that's, hesitation. And it can come in many forms, like I said, monetary or social, right? If you're trading in front of other people, it can be scary, right? To be able to trade and then be proven wrong in front of a bunch of people. But you really have to let that stuff go. And I know that's kind of like an airball of an answer.
Let the chair do it.
Exactly, right? That's kind of an air ball of an answer, but at the end of the day, you can't be so caught up. I know a lot of us are young. We want to go out and prove something, but no one cares. This is going to be a huge, huge statement. Nobody cares whether you win or lose in the market. Yep. You shouldn't care, right? Now, to an asterisk, right? You should care to improve, but you shouldn't care on each individual trade as long as you did everything you were supposed to in your strategy and your mindset and with logical price, sound, time, price, and delivery, right? So if you're getting all upset and frustrated and get into tilt trading because you took a loss or you're hesitating, right? That's not something you want to do, and you have to take notes of that and you have to record that. A good thing that I do, right, if I'm considering hesitating, I really remind myself that, hey, I have sound, price, and time here. If it's a perfect setup or a great setup, we don't know if it's perfect until, of course, it happens, right? If it's a great setup and it's time and price, I have nothing to prove to anyone who is watching me. I have only time to learn, right? If it's a win-win, you have to really look at the market as a win-win for always, right? If you win, awesome. You earned more to trade for the next time you want to put in a trade, and you can take some for yourself. And if you lose, it's a great learning opportunity. You got front row seats. You have to really look at that. You get front row seats of what the market's doing. If the market proved you wrong, that's great, because unlike other traders who are still kind of on the fence about an idea, you got proven wrong and said, wow, I was thinking this, but I saw this. This is what market's trying to do now. And even in, for example, let's say you were taking like a fair value gap setup and you see price action, inverse that fair value gap. ICT makes a note of, hey, you can really see price action. Okay, is inversing that. You get that front row seat. Maybe wait for price to retag it, take half the position you were in, and then go ahead and try to earn a great trade right there. So you get that front row seat. So don't be afraid of losing. It is really the tuition that you pay. Everyone's lost. I have lost. Your mentors have lost. ICT has lost for years, 30 years, right? And again, He's still one of the best traders out there, in my opinion. And
Except
again,
me. I'm that guy.
okay, second to Ben.
I'm gonna show
Off.
myself losing when I edit this video. Watch. I'm just gonna put like
And
get stopped out, get stopped out, get stopped out, get stopped out.
you just need the order. You need the stop filled sound effect play.
Stop field. And just me screaming.
Anyway, but we'll get them next time.
Exactly.
This is the GTA wasted sound effects. Anyway, but that's how I handle, right? So if I'm in a moment where I'm hesitating, I really just think, okay, it's a win-win situation. If I win, awesome, cool. And if I lose, I get front row seats. I get to pay the tuition. I get excited to be able to study that afterwards. And every time I lose on stream, I go, all right, man, this is going to be a good one to study afterwards. And later that night with the team or anyone who joins during our power hour in the Terra Trading server at 8 p.m. EST, where we're just going over the market, where we go over ICT episodes and content, right? We just say, hey, this is the trade I took. This is what happened. This is why it happened. Very simple. How can we improve? Take notes, journal, reflect. That's all you need to do, man.
I love the fact that you do that, man. For me, I don't know. I have like I get upset. Like I know I shouldn't, because there's math behind long-term success, right? If you use proper risk management and you have a model that's been proven while backtesting, right? And you keep taking the same setup, eventually, the gains are going to add up. But for me personally, even with so much experience, dude, it hurts. Like it still hurts me. Like I got obviously an immune system built up towards it, obviously now, but sometimes it still stings, even for me, like last week. Last week is a good example. I had a bunch of break-even trades, mostly break-evens. Like today, I had 2 break-even trades and 1 win, and believe it or not, you see that order block you marked out? Go on the 1 minute. Go on the 1 minute. I'm gonna show the guys. So look. That I entered off the first time it tapped the order block. You see it? The first time. Yes, exactly. And I ended up trailing right above the right side, and I got stopped out right before the buy side got hit. I went break even right at the black line, and I got stopped out. Then it went my direction. I looked for a re-entry, but I entered, and the market, see that candle that popped up like crazy? Right there.
Yeah, absolutely.
It's a little bit higher, like towards the right. Like the second. Yeah, there you go. Yeah, see the wick right next to it.
Yeah,
at the bottom left. Right there. I entered right there. That was my entry point, and I wanted to put my stop loss right under the black candle, right, 50% of that candle, and it would have been an amazing RR. It would have been a 1 to 3.5, but I was only able to get a quarter of my risk percentage in. I enter with 5% usually, and I was only able to enter with about 1%. So that trade, I ended up having a bigger RR, and I told myself, listen, I'm going to go break even, and I have to hold this trade until I get my quarter of percentage like I usually do. So if I make usually 10%, I have to hold until 10%. Some people might think that's a bad mindset, but I'm thinking long term, And I got break even right there as soon as I came back. TP was 50% away. I looked for a re-entry, and I got the win right at the highest point, right there. And that's it. Like don't take it too personal. That's my opinion. Think about it more of like, what? Let me take the trades that make sense. Let me be cool, calm, collected. And if you can't be cool, calm, collected, get off. Like Kane said, which I have almost framed. Like I feel it in my hands. A canvas. It's like I got a canvas. I feel it. It's in my hands.
That's awesome.
And I'm gonna be holding it. And when somebody is gonna complain about, man, we got break even again, or another break even, who cares? At least you didn't lose money. And there's always another
at least
trade.
you're not making a loss.
Yes, right? Exactly. So chat. Well, viewers. Because I'm not live. I say chat, but
chat
don't
viewers,
take it so
we
personal.
know who you are.
Exactly.
You know who you are.
And my final question to you, Kane, is how do you spot consolidation? How do you avoid trying to be in the accumulation phase? Because a lot of times, my solution is if you have a huge move prior to 9:30 or a huge move, like I'm talking 300 or 400 points overnight, usually it's going to consolidate. Or you have like FOMC or Powell speaks, usually in the morning sessions. It's not that good. It's still volatile, but it's not moving. Or bank holidays. How do you avoid consolidations?
Yeah, it really comes down to experience. And, well, two things in my opinion: time and experience. Now, those sound like the same thing, but time when it regards to the market, and of course experience, doing it over and over a period of time.
Absolutely.
Now, first, starting with time in the market, there are going to be a ton of different macros, like we discussed, where we should expect price action to get a move on and start targeting out some key inefficiencies in liquidity, right? And you can likely catch some key tail ends of those moves with the right timing. As we discussed here, 1050 macro is accumulating for about, 20 minutes right there, but around 1050 starts getting its move on all the way up there to that inefficiency right there. And
Absolutely.
that's one way of it. And of course, once you see price action take out some key inefficiency or tag into a key set of liquidity, you should probably expect consolidation. And consolidation, in my mind, means one of two things, right? One, it means it's going to get more gas and more orders to keep pushing price, in this case, higher, right? Or it is preparing itself, taking these orders out, working its way, engineering liquidity, so that way it can make a reversal. And that's something you got to be aware of. If it is accumulating, but it hasn't hit that key target, it's likely going to push higher. But if it's hit some key targets and key areas, we could likely expect a reversal. Targets could be below previous accumulation levels. That's how you handle that. Now, the second thing of experience is, like you were talking about, holidays and news, where we're going to see a ton of examples where there's going to be accumulation, right?
Yeah.
For example, in the days... Oh, yeah, absolutely. And so, for example, in the mornings of like FOMC, we may see some decent price action for about like 30 minutes to an hour, but then we'll probably expect to see some accumulation and chop leading up to that high impact news. Or, for example, on a holiday, we're probably going to see a lot more accumulation because there's a less, right, of those institutional banks trading, and therefore not really any major reason to go up and target out opposing liquidity, right? So that's those experiences that you're going to get as a trader, right? And even in the times of specific seasons and holidays, right, as you're going to be trading more over the year, you're going to experience different trading conditions based off the time of year to really understand, okay, we might get an accumulation on like a 4-hour time frame, right? And you might just be going through the ranges. So you have to be very aware. But as for the low time frame accumulations, really look at those macros, look at how price action delivers through those, understand the key inefficiencies and liquidity at play that can cause accumulation to occur, and what the result of that accumulation might likely be.
I love it, King. Thank you so much for your time and your patience with me.
It is all good. I want to thank you again for giving me the time and spotlight out here.
Make sure
I really do appreciate it, being able to share the knowledge.
Make sure to check out Kane's Discord. It's going to be in the link of this video. Also, his YouTube channel at Kane Trades. He has a full-on... How many episodes do you have of mentoring?
I think it's like 51. So if you want to learn everything that I do a trading now, I will say it's a little bit older to what I'm trading more now, but still, it still understands SMC confluences. So if you want to learn everything from square one to the bare basics of liquidity to psychology to understanding how you can make money in this industry, I got a full series on my YouTube channel, absolutely free, because again, we don't charge for concepts that aren't ours. We're just lucky to trade them. And of course, yeah, we're getting up to a close around 1,000 subscribers, so appreciate it if you would drop one. And again, thank you, Ben, for your time. Thank you for letting me have the spotlight here. And it was fun to do another interview. Hopefully, might be back on third time. I can't wait to see that poster too.
Sir. Oh my God, I wasn't recording. I'm joking.
No.
Yeah, no,
no.
Your face
You can't
dropped.
do that to me. You
Your
can't
face.
do that to me, Ben. You see, I have, as a recorder and content creator myself, the amount of times where I have recorded and not recorded, or
your
the
face
amount of times
dropped,
where I've
dude.
recorded, the amount of times where I've recorded and had like double audio because my camera was picking up audio and my mic was audio, and I've recorded just like a 30-minute video. Oh, that hurts my soul. You can't do that.
I got you good,
All
huh?
right, my friend.
All right, I love you, brother.
No comment, man.
All right, man. Love you, bro. I'll see you soon.
Take care.
Yeah, thank you, bro.
I love you too, Brandon. Take care.
Yes, sir.